The exit from recession in the fourth quarter of 2020 brought about a renewed hope for full recovery in 2021, notwithstanding the obvious downside risks to the entire global economy. The committee appraised the developments in both the global and domestic economic and financial environments first quarter of 2021 and the outlook for the rest of the year. 9 members of the Monetary Policy Committee were in attendance at this meeting. Global economic environment development. The committee noted that while vaccination against COVID-19 had gained significant grounds in major advanced economies, some emerging market and developing economies were yet to commence any form of vaccination. This development portends an uneven recovery to global growth as barriers to trade and the global supply chain are likely to remain in place more than anticipated, prevent reinfection in countries that have achieved significant vaccination and some form of herd immunity. The growing concerns associated with the efficacy of these vaccines, especially in the face of new variants of the virus, however, poses a significant threat to the overall recovery of the global economy. The broad direction of the expected rebound in global output recovery varies across countries depending on the headwinds confronting individual economies. Consequently, the IMF projects a growth rate of 4.3% for advanced economies and 6.3% for the emerging developing economies, with a global growth rate of 5.5% in 2021. The downside risks to this projection are associated with concerns that existing vaccines being deployed may not effectively subdue the new and existing variants of the virus, and thus restrictions may remain in place which may hamper the speed of expected recovery globally. Price developments across major advanced economies remain subdued, despite the expectation that output gaps will remain negative into the medium term. In the emerging market and developing economies, price development was, on average, mixed, with some economies recording inflation rates that were significantly higher than those seen in the advanced economies. This was mostly due to the continued capital outflows, poor accretion to reserves, and exchange rate depreciation, which has a pass-through effect to domestic prices. In the global financial markets, conditions remain relatively stable as central banks continue to maintain expansionary monetary policy and sizable stimulus packages. The huge level of monetary and fiscal injections may heighten the risk of financial instability, especially when central banks commence adjustment of policy rates. Domestic developments. Real GDP, according to National Bureau of Statistics, recorded a growth rate of 0.11% year-on-year in the fourth quarter of 2020, in contrast to minus 3.62% during the third quarter of 2020 and 2.5% in the corresponding period of 2019. The fourth quarter 2020 performance was a sharp rebound in contrast to the 2 previous quarters of negative growth, which were minus 3.62% in the third quarter and minus 6.1% during the second quarter. The improved performance was driven by the non-oil sector, which grew by 1.69% during the fourth quarter of 2020 from 2.51% and minus 6.05% during the third quarter and fourth quarter 2020 respectively. The major drivers were quarrying and other minerals, which grew by 48.42%, and ICT subsector, which grew by 17.64%. The oil sector contracted further by minus 97% during the fourth quarter of 2020 from minus 13.89 and minus 6.63% during the third and second quarter of 2020, respectively. This was attributed largely to the decrease in oil production in compliance with OPEC production cut agreements. The committee noted the moderation in the manufacturing and manufacturing purchasing managers' indices, which, however, remained below the 50 index points in February 2021, but improved to 48.70 index points compared with 44.9 and 43.3 index points, respectively, in January 2021. The GDP growth in the fourth quarter of 2020 and expected recovery during the first quarter of 2021 were signposted by these observed improvements in the purchasing managers' indices. The employment level index component of the manufacturing and non-manufacturing PMIs also improved moderately in February 2021 to 45.6 and 48.0 index points, compared with 44.2 and 45.0 index points, respectively, during the previous month. The committee, however, expressed some optimism that the legacy growth headwinds attributed largely to the resurgence in the infection rate of COVID-19 pandemic may likely recede in the short to medium term as the successful deployment of the COVID-19 vaccines, the various stimulus packages to revamp the domestic economy are sustained. Committee noted with concern the continued uptick in inflationary pressures for the 18th consecutive month as headline inflation year-on-year continued on an upward trend to 17.33% at end of February 2021 from 16.47% in January 2021. This increase continued to be attributed to the increase in both food and core components of inflation, which rose to 21.79 and 12.38% in February 2021, respectively, from 20.57 and 11.85% in January 2021. This persistent uptick in food inflation, however, was the major driving factor to the uptick in headline inflation. This was due to the worsening security situation in many parts of the country, particularly the food-producing areas, where farmers faced frequent attacks by herdsmen and bandits in their farms. While the bank is intervening significantly in the agricultural sector, the rising insecurity in some food-producing areas is limiting the expected outcomes in terms of supply to the market, thus contributing to the rise in food prices. The committee further noted that the key drivers of the increase in core inflation included the hike in the price of premium motor spirit PMS, popularly called petrol, upward adjustment in electricity tariffs, and the depreciation of our currency. The committee observed that broad money supply M3 grew marginally by 0.3% in February 2021, following a substantial growth of 13.54% in December 2020. This was driven largely by the contraction in net foreign assets. The committee also noted that net domestic assets grew by 3.02% in February 2021 from 2.22% in December 2020. Banking system credit to the economy increased by 1.32% to 51.98 trillion naira in February 2021 from 51.30 trillion naira in January 2021, reflecting the ongoing broad-based monetary and fiscal stimulus to various sectors of our economy. The committee thus enjoined the bank to maintain its current drive to improve access to credit to the private sector while exploring other initiatives with the fiscal authorities to improve funding to critical sectors of the economy. Conscious of the persisting inflationary pressure, fueled largely by continued uptick in food prices, committee noted the bank's interventions to boost food production, particularly through its various agricultural programs. Other complementary measures included increase in disbursement for the dry season agricultural program to increase output, the adoption of high-yield seeds to improve productivity, and the adoption of harvested produce as a means of loan repayment, which has stemmed hoarding and the activities of middlemen and rent seekers. The establishment of the strategic grain reserves for staple crops has also helped in addressing seasonality of agricultural commodities. In terms of funding, committee noted the banks has disbursed funding under its various agricultural interventions towards improving food supply in Nigeria. Committee also noted the disbursement of 107.6 billion naira to 548,109 farmers cultivating 703,619 hectares of land between the of 2020 and the first quarter of 2021 to boost dry season output in support of agricultural value chain developments. Total disbursements as at February 2021 amounted to 1.487 trillion naira to date under the various agricultural programs, out of which 686.59 billion naira was disbursed under the Commercial Agricultural Credit Scheme and 601.75 billion naira under the Anchor Borrowers Program to 3,038,649 farmers to support food supply and dampen inflationary pressures. Under the Targeted Credit Facility, which is meant for households and very small and micro businesses, the bank has disbursed 118.16 billion naira to 475,376 beneficiaries, out of which 34% of these beneficiaries are micro, small, and medium enterprises. Under the Agricultural Small and Medium Equity Investment Scheme Program, AXMIS, 111.62 billion naira has so far been disbursed to 28,961 beneficiaries, 70% of which are in the agricultural sector of the economy. Under the Creative Industry Finance Initiatives, which is primarily targeted at our youth, 3.19 billion naira has been disbursed to 341 beneficiaries, out of which 53% of it is to the movie industry. Under the National Mass Metering Program, 33.45 billion naira has been disbursed to 9 distribution companies for the procurement of 605,852 meters, while 89.89 billion naira has been disbursed under the Nigeria Electricity Market Stabilization Facility, NEMS 2, to 11 distribution companies to improve the electricity supply industry in Nigeria. Under the 100 billion naira Healthcare Intervention Fund Program, the CBN has disbursed 94.3 billion naira to 85 projects in the pharmaceutical industries, hospitals, and state governments for both brownfield and greenfield projects, mostly to expand pharmaceutical drug lines, acquire MRI and other equipment, and upgrade laboratories and other hospital services. Indeed, let me say that the CBN is still willing to even expand the facility, noting that almost 100 billion that was set aside for this program is already been achieved. Under the 1 trillion naira manufacturing intervention stimulus, the total of 803.36 billion has been disbursed to 228 projects across various sectors in the agro-allied, mining, steel production, and packaging industries, amongst others. The monthly weighted average interbank call and open buyback OBB rates fell to 1.8 and 1.5% in February 2021 from 3.5 and 2.30% in January 2020, respectively, reflecting the continued liquidity surfeit in the banking system. The committee noted the weak performance in the equities market despite the recent increased patronage by domestic investors. The all-share index and market capitalization continued to decline due to portfolio switching from equities to fixed income securities, reflecting the perception of improved yields at the long end of the yield curve. All-share index decreased by 1.17% to 39,799.89 points on February 26, 2021, from 40,270.72 on December 31, 2020. Similarly, market capitalization fell by 1.11% to 20.82 trillion naira on February 26, 2021, from 21.06 trillion naira on December 31, 2020, over the same period. This was attributed largely to investor sell-off, which continued to cause price depreciation of large and medium capitalized stocks. The Monetary Policy Committee noted the performance of the financial soundness indicators of our deposit money banks, which showed a capital adequacy ratio of 15.2%, non-performing loans ratio of 6.3%, and liquidity ratio of 40.5% as at February 2020. As regards non-performing loans, the MPC noted that the ratio remained above the prudential benchmark of 5% and urged the bank to sustain its regulatory measures to bring it below the prudential benchmark. Committee noted with satisfaction the improvement in the level of external reserves, which stood at $36.46 billion as at the end of February 2021, compared to $34.94 billion at the end of January 2021. This reflects the recent upsurge in crude oil prices on the backdrop of the renewed optimism on the successful deployment of COVID-19 vaccines across the globe. Our outlook. The medium-term outlook for both the domestic and global economies indicates cautious optimism. This is premised on the expectation of sustained policy support and successful deployment of COVID-19 vaccines around the globe and its effectiveness in ensuring herd immunity. Available data on forecasts for key macroeconomic variables for the Nigerian economy suggests further rebound in output growth for the rest of 2021. This is predicated on the sustained as well as additional interventions by the monetary and fiscal authorities to keep up the recovery momentum in the economy, favorable upsurge in crude oil prices, foreign exchange market stability, and successful deployment of the new COVID-19 vaccines that could further stimulate economic activities and ultimately boost output growth. Given the potential rebound in output growth, bolstered by the resumption of economic activities post-COVID-19, inflationary pressure in the economy is projected to moderate in the short to medium term. The underlying risks of the efficacy of the COVID-19 vaccines against known and newly emerging strains of the virus, the uncertainty that the existing vaccines could lead to herd immunity and unequal access to COVID-19 vaccines, however, are some of the headwinds that could undermine our forecast. The committee's consideration. The committee noted the moderate recovery in output growth during the fourth quarter of 2020, associated mainly to the positive impacts of the several monetary and fiscal measures implemented to reflate the economy following the negative consequences of the COVID-19 pandemic. This, in the committee's consideration, provides an opportunity for further consolidation, as most projections suggest substantial recovery across several economies throughout the world. However, the committee was not oblivious. Downside risks to the broad outlook for recovery in 2021 as efforts to achieve herd immunity continued to face significant headwinds. The committee welcomed the current efforts by the government and other support agencies in procuring vaccines and thus urged the quick and efficient deployment of the vaccines to support ongoing monetary and fiscal stimulus towards full recovery of the Nigerian economy in 2021 and into 2022. Members expressed concern about the unabated rising trend of domestic prices and emphasized the exigency for monetary and fiscal policy collaboration to finance productive ventures, improve aggregate supply, and push down prices. The MPC reiterated its concerns on the activities of persons and groups causing security challenges in the food producing areas of the country, as this has contributed to the major uptick in food prices across the land. Committee thus called for a collaborative and coordinated effort by all the relevant agencies and stakeholders towards addressing the prevailing insecurity issues and social challenges. Committee also called on the government to explore the option of effective partnership with the private sector to improve funding sources necessary to address huge infrastructural financing deficit. Considering the foregoing, MPC noted that fiscal headroom remained constrained and fragile following the twin shock of the pandemic and oil price volatility and the continued build-up of public debt. MPC noted the bank's innovative efforts towards maintaining exchange rate stability. It also impressed on the management to remain focused on its drive to increase accretion to reserves, especially in its recent incentives to attract diaspora remittances into the country. Committee welcomed the relative strengthening of the money market rate compared from its position at the end of the lockdown. Mindful of the risk confronting the economy, it emphasized the need for fiscal authority to improve the investment climate towards attracting sustainable foreign direct investments. The committee recommended the bank for maintaining a robust regulatory environment despite these challenges by ensuring that non-performing loans driven down to prudential levels even as aggregate credit continue to grow in a market confronted with relative uncertainties. In summary, the MPC noted the overarching need to address the twin major challenges of taming the rising inflation and sustaining growth recovery in the economy, while focusing on downside risks associated with their injections. The committee's decision. At this meeting, the dilemma that confronted the Monetary Policy Committee relates to whether to continue to focus on efforts to stimulate output growth or whether to focus on reining in inflation, which at 17.33% is almost attaining the January 2017 inflation level of 18.72%. MPC was also worried that the level of unemployment must be addressed swiftly so as to moderate the restiveness among the populace. Again, members were generally of the view that given that the exit from recession is fragile, any decision to tighten or rein in inflation may reverse the fragile recovery and return the country back to recession. In the light of the foregoing, the consensus amongst MPC members was that Given that inflation is substantially a supply-side phenomenon, there is need to continue to focus on consolidation of the recovery process by taking those actions that would continue to stimulate output growth, create employment, but at the same time, have an eye on efforts to moderate the inflationary pressure using the current administrative measures being adopted by the bank in controlling monetary aggregates in the banking system. In its consideration of whether to tighten, hold, or loosen, therefore, committee felt that with inflation at a 3-year high, this being the bank's core mandate of price stability, a contractionary policy stance may be required to tame the rising trend. It nevertheless feels that tightening will hike the cost of capital and hamper investments required to create employment and continue to boost recovery. On the other hand, committee thinks that whereas loosening would lower rate and improve access to credit, which will drive investment, reduce unemployment, and stimulate aggregate demand, it feels that loosening will create excess liquidity, which will intensify demand pressure on the foreign exchange market, thereby leading to further depreciation in the currency naira. It therefore feels that a hold position, which encourages management to continue to use its various intervention mechanisms to deploy liquidity into employment generation and output stimulating sectors of the economy, will be desirable, as this would help consolidate the country's recovery process. The committee therefore decided by a vote of 3 members to increase MPR by 50, 75, and 50 basis points respectively, and 6 members voted to hold all parameters constant. In summary, MPC voted 1, to retain MPR at 11.5%, 2, retain asymmetric corridor of plus 100 and minus 700 basis points around the MPR, 3, retain the CRR at 27.5%, and 4, retain liquidity ratio at 30%. Thank you very much for your attention.
Thank you. This is the communique of the 278th meeting of the Monetary Policy Committee of the Central Bank of Nigeria. Thank you, Governor, once again. We'll take a few questions. You mention your name, the media organization you work for, and your question. Thank you.
Good afternoon, Mr. Governor. My name is Ndoka Chejin of the National Bank. Inflation is now 17.33%, given all the efforts that CBN has been putting in place to check it. Now, what is the CBN considering to manage inflation, given its efforts to stimulate the economy? Thank you very much.
Good afternoon, Governor and your team. My name is Chinemerem Joseph. I work for Arise News. Just yesterday, we saw a report alluding that the Minister of Finance spoke about a new flexible exchange rate regime. This question is very appropriate to you, the Governor. So has Nigeria adopted a flexible exchange rate policy for official transactions, as this is now viewed as another devaluation of the Naira? And secondly, sir, as you and your team prepare to head to Gombe for another rice revolution, the rice pyramids we'll see around, there are a lot of questions around when the price of rice will crash, because a lot of bags are being seen on display. So they're wondering, but we still go to the market and buy it on a very high cost. So when is the price crashing, or we are not yet there? Of course, we know we are not producing enough yet. Thank you, sir.
Good afternoon, Governor. My name is James. I write for these day newspapers. There are reports, sir, that there seems to be scarcity of foreign exchange in the deposit money banks. And this has made it difficult for parents to pay the fees of their wards in schools. How is the CBN looking into this issue? Thank you, sir.
Good afternoon, sir. My name is Leah Katumbabatunde from NTA. Just recently, the CBN and the NCC broke out an understanding between the telecommunications companies and the deposit money banks for an amicable resolution of the USSD impasse. What do Nigerians stand to gain or benefit from this truce?
And Governor, the final question is coming from Obinna Chima of This Day. He sent it online. And the question goes, some Nigerians have argued that the CBN policies are targeted against the creative talents of our youth. What are your views, given the high unemployment rate, particularly among the youth? Thank you, sir.
Well, thank you very much. On the first question that says that given that inflation at 17.33% is almost going to our January 2017 levels, and in spite of all the measures that we have taken, that what else do we have to do? Well, you would recall that at this meeting, just like in some of the very recent meetings, Monetary Policy Committee has been confronted with policy dilemma. The policy dilemma that has to do with the fact that Nigeria is seeing, and in this meeting, 18 consecutive months of inflationary pressure, prices rising, while at the same time, before this meeting, we were confronted with also the challenge that is associated with a contraction, which was stagflation, in our view. And in dealing with these situations, you want to deal with inflationary pressures, you will have to adapt some tight monetary policy measures to rein in inflation. When you adopt a tight monetary policy stance, what it does is that it constrains liquidity, makes interest rates high, and makes life difficult for those who want to access credit. If people cannot access credit, then it means they cannot go into gainful productive activity that would help stimulate growth, output growth, and therefore help. So on one hand, monetary policy felt, look, we have these twin challenges which are running in opposite directions. You want to stimulate output growth. What you need to do is to loosen, stimulate the economy so that output growth can be stimulated, consumption spending can be stimulated. Whereas on the other hand, you have inflationary pressures confronting you. Inflation itself has its own damaging effect on purchasing power and the standard of living of the people. And what you will find is that what you need to do to tame it is to adopt some measures that tightens liquidity so as to rein in inflation. At this meeting, the Monetary Policy Committee deliberated extensively on this matter. And we felt that the country haven't just crawled out of recession, because that was the word we decided to use, not even fragile, just managed to crawl out of recession. Should monetary policy be tightening in a way that creates disadvantage or disincentive to activities that will stimulate output growth and therefore reverse us back to recession, or that we should continue to bolster or stimulate the economy so as to be able to consolidate on growth? So that's what we deliberated on extensively. And Monetary Policy Committee members came to the conclusion that given that we're just crawling out of recession, there's a need for us to continue to do those things that we did and more intensely those things that we did that took us out of recession, looking at supporting interventions, particularly in the agricultural sector, in the manufacturing sector, in the ICT sector, in the services sector, that where we had double-digit growth, in the creative industry sector, in all those other sectors that helped us to exit the recession. We should look at intervening in the health sector. We should look at possibility of even doing more, creating more loans through our targeted credit facilities for our households and small businesses particularly that were adversely impacted by COVID. Knowing fully well that when we support households and medium and small enterprises, what that will result is that it will stimulate spending that will ultimately lead to aggregate demand and then bolster our gross domestic product. So we decided that yes, while even doing this, we must also take certain decisions, certain actions, in this case administrative actions that would help to moderate the rate of acceleration of inflation until we are comfortable that output has already attained what we can call a cruise level before we can begin to effectively and aggressively tame inflation. So we will continue on those because we know that things are not just right yet. But we are lucky that we are in a position where we have an opportunity, and I use the word again, to reset our economy and push in a positive direction for growth that will really impact positively on the life of our people. So that's what we will continue to do. But we are not going to lose sight on the rate of inflation. We will not lose out on rate of inflation. Yes, we may see it still maybe slightly move, maybe in April. Most of our forecasts say that it may move up into April, but that from around May, we may begin to see a moderation in inflation at a level that by that time, hopefully, we would have seen the first quarter output numbers, GDP numbers, which we hope will help to consolidate on the recovery and then begin to attack inflation very aggressively. So we are saying that the MPC is still looking very aggressively at inflation, but at this point, let's see to how we can consolidate on growth of the economy. The second question talks about some interviews from the report of Bloomberg that attributes the fact that Nigeria has moved into a flexible exchange rate, or their own conclusion from what the Minister of Finance said is that Nigeria has moved effectively into a flexible exchange rate. Let me repeat that Nigeria has not changed from its foreign exchange management policies. Nigeria still remains on a managed float. What does the managed float regime mean? That the central bank, being the institution that has a core mandate for a foreign exchange in the country, would run the market, see to how the market operates, depending on its reading, how exchange rate moves in the market, will come from time to time to intervene in the foreign exchange market. It might interest us to know that since January, the CBN has not intervened in the I&E window. The market has always operated within a band of around close to about 409. In fact, at some point, it attained 412, went to 413, and began to move. And that is where it's supposed to move. And then central bank's job is to watch the market and see how it's operating, and from there determine whether or not it should intervene to moderate the rate in the market in line with our own reading of where we think exchange rate should be. So when Bloomberg begins to conclude from the statement of the minister, which I believe is not true because I've not heard that audio, that we have moved into a flexible exchange rate regime, I would just try to appeal to members of our press community that when you have an information, it is always better for you to seek clarification, particularly from the authority. Section 4, Section 2A of the CBN Act, and I will read, places the object, it says the principal object of the CBN shall be A, ensure monetary and price stability. B, right?
Well, that was the Central Bank Governor Godwin Emefiele, of course, announcing the decisions of the Monetary Policy Committee at this meeting. And of course, the committee decided to keep all monetary policy parameters unchanged. Well, I still have my guest here, Robert Omotunde, in the studio here, and of course, Paul Alaji in Abuja studio. Well, gentlemen, a quick one before we round off this session, and I'm going to take it from the last statement that the central bank is. We're talking about the exchange rate here. Of course, you heard the central bank governor. Yes, the central bank is still operating a kind of a managed exchange, not a flexible one. But the fact that the government, of course, is still talking about now operating the 410 Naira NAFEX rate.
Well, so what I think the governor was trying to clarify is the fact that, you know, we had investors and exporters window that was opened in 2017. That's the market that allows the banks and, you know, the eligible players in the market to play. Now, that market is supposed to be a market reflective system, so to speak. That is the NAFEX rate, so called, is supposed to be the rate that you derive from the INEFX window, in which the central bank is also a participant. At some point, the significant play of central bank was as high as 30%, 40% at some point. So what the central bank was trying to clarify is that as it is right now, they haven't moved into a full-fledged flexible exchange rate, but that they've remained at the level that they have been, which is that it's a managed floating. And like you said, the duty of the central bank is to play in the market as well as other players in the market. I think that's what it was profound in what he said.
All right, we'll see how that goes. Okay, Paul, let me come to you. What is your take from what you heard from the central bank governor?
Okay, so from what the central bank governor mentioned, is not different from what we have projected and what we assume will be the situation today. It's almost exactly the situation. But he mentioned some very salient points as to what authorities must do in terms of securing farms and also ensuring that we have better output, we reduce supply shocks, which is the reason why inflation is so high. He is also very hopeful that by Q1 report, which we hope will be published sometimes in April or early March by National Bureau of Statistics, which means that by the time MPC is meeting again, maybe May, hopefully, we will now see if the situation would have improved. But my opinion is that anything lower than 50% of population growth rate, which is average of 3%, if you have anything less than 50% of population growth rate as GDP growth rate, it will be too early for us to adjust key parameters because we know such growth will still be very, very weak and very, very fragile.
Thank you very much, gentlemen, for joining me on the show. I do appreciate your time. Mr. Paul Alaji there, thank you very much. I appreciate your time. And of course, Robert Omotunde, thank you. I mean, you came all the way in the rain. Thank you very much. I appreciate your time. Let's just hope that we eventually get things right. And that's it on the program. Thank you for watching. I'm Chimeze Obi. Wow.